Japan's stock market just crossed 65,000 points for the first time in history. And most Americans heard that and thought, so what? That is exactly the reaction that is going to cost them. Because what just happened in Tokyo is not a foreign story. It is a direct warning signal for your savings, your investments, and the purchasing power of every dollar sitting in your bank account right now. If you click away in the next 30 seconds, you will miss the one move that separates the investors who protect their wealth from the ones who watch it quietly shrink. Stay with me. Let's be honest about where most Americans are right now. Inflation came in hot. It cooled a little, but your grocery bill didn't get the memo. Interest rates stayed high for longer than anyone expected. Your mortgage, your car payment, your credit card, all felt it. And wages? They technically went up, but somehow at the end of every month, there's still less room to breathe. That feeling is not paranoia. It is math. The Federal Reserve's own data shows that the real purchasing power of the US dollar has declined significantly over the past 4 years. You are not imagining it. Your dollar is doing less work than it used to. And here's where Japan walks back into the conversation. Because the Nikkei hitting 65,000 is not random. It is the result of a very specific global financial dynamic, one that has a direct pipeline straight into your portfolio. The framework we're using today is called the global carry ripple. And once you understand it, you will never look at a foreign market headline the same way again. But first, let me show you exactly what broke loose in Japan and why it matters for the money sitting in your accounts. Because the mechanism I'm about to walk you through, it has already moved US markets 3 times in the last 18 months, and most investors had no idea why. Here's what you need to understand. Simple, unhurried. For years, Japan kept interest rates near zero, basically free money. So global investors did something very logical. They borrowed in Japanese yen at almost no cost, and then invested that borrowed money into higher returning assets, US stocks, US bonds, US real estate funds. This is called the yen carry trade, and it's one of the biggest, quietest forces in global finance. Think of it like this. Imagine you could borrow from a vending machine that charges you almost nothing, but instead of buying snacks, you invest that borrowed money in the S&P 500. You profit on the spread. You win while you borrow. But here's where it gets dangerous. The moment Japan's economy strengthens, the moment the Nikkei surges to 65,000, Japanese central bank starts talking about raising rates. And when that happens, those carry trades unwind. Investors rush to repay their yen loans. They sell their US assets to do it. This is not theoretical. In August 2024, a single shock from the Bank of Japan triggered the largest single-day drop in the Nikkei's history, and US markets cratered in the same window. But here's the thing, and this is what the average investor missed entirely. That same mechanism works in reverse. When Japan surges confidently, when the Nikkei climbs steadily to 65,000 without panic, it signals something very different. It signals synchronized global growth. It signals that capital is expanding, not contracting. Definitive. Close out this section strong. And that changes the playbook for your money entirely. But knowing the global picture means absolutely nothing if your money is sitting in the wrong place to capture it. Which brings us to the 3 moves you need to make right now. Move 1. Stop letting your cash sit idle. If the global carry trade is unwinding, if capital is rotating, moving, repricing, then cash sitting in a 0.01% checking account is not safe. It's shrinking. Take a look at this simple chart. It shows the effect of inflation on savings accounts since 2020. It basically shows a slow leak in your wallet. The move is a high-yield savings account. HYSA. Right now, the best HYSAs are paying between 4 and 5% annually. That's not spectacular, but it's the difference between your emergency fund keeping pace with inflation or quietly losing ground every single month. Think of your HYSA as the foundation. It's not where you build wealth, it's where you protect wealth while you decide where to build it. But an HYSA alone is not enough, because the real wealth building engine is in what global capital does next. Move 2. Make sure you have US market exposure inside a tax-advantaged account. When global carry trades unwind and reinvest, a significant portion of that capital historically flows back into US equities. The S&P 500 is still the world's reserve investment. When global investors get scared, they sell. When they get confident, like they are right now, they buy. If you don't have a Roth IRA maxed out, you're leaving compounding growth on the table, tax-free. The 2025 contribution limit is $7,000. That's $7,000 growing in an account where you will never pay capital gains tax on the gains. Compound interest isn't magic, it's math, but it feels like magic after 20 years. If you're 30 years old and you put $7,000 a year into a Roth IRA invested in a broad US index fund at a conservative 7% average large annual return, you will have over $1.4 million at age 65, tax-free. Pause. 2 short lines, let each one land separately. Not because you were a genius, because you started and you stayed. Step up again. Final move, make it feel like insider knowledge. Move 3, watch the yen-dollar spread. It's your early warning system. Reassuring, accessible, remove the intimidation. You don't need to trade Forex to use this signal. 2 contrasting scenarios. Pause between them, clear and deliberate. When the Japanese yen weakens sharply against the US dollar, watch your equity exposure. Carry trade stress is building. When the yen stabilizes or strengthens, like it has been doing during this Nikkei rally, that's a green light signal that global capital is stable and flowing. Short, punchy, like you're letting them in on a secret. Most retail investors never check this, but now you will. Practical, grounded, simple action step. Add the USD JPY rate to whatever finance app you already use. Check it once a week. It'll tell you more about what global capital is doing than 90% of the financial news headlines you scroll past every day. Pause. Shift tone. This is the warning moment. But here's where most people make the fatal error. Slow, deliberate, like you've seen this 1,000 times. They understand the strategy. They nod along, and then they do nothing. Slightly exasperated, human, relatable, because they're waiting for the perfect moment to start. Firm, final, no room for argument. There is no perfect moment. The Nikkei hitting 65,000 is the moment. The signal is live. Every month you delay opening a Roth IRA is a month of tax-free compounding you can't get back. Every month your savings sit in a low-yield account is a month inflation quietly takes its cut. The global economy doesn't pause while you decide if you're ready. Pause. Softer. Sincere. Japan's market just sent a signal. The question is whether you receive it. The investors who build wealth aren't smarter than you. They simply acted when the information was in front of them. That information is in front of you right now. And if you want to understand the next piece of this puzzle, because there's a bigger global currency shift happening underneath all of this, one that threatens the dollar's dominance over the next decade, I've already broken that down completely in the video right here. Watch it next, because what's happening with Japan is just chapter 1.